Put a wrap on preferred stock. So it's exercise 13.5. Here it is. And so I'll put this here. I'll turn out that light so it's readable. All right, so match each of the description 1 through 6 with a characteristic of preferred stock that is best described by writing the letter. Okay, cumulative, non-cumulative, convertible, callable, non-participating. Oh, not participating. The way this works, if a preferred stock is participating, what happens there is they get what's due. In this case, the $30,000. Then the common stock get a certain percentage, and then above that, it's divided between the common and the preferred. So if it's participating, it means the common stock also have a cap on their dividend. And if they reach the cap, then it's divvied up between the preferred and the common. Does that make sense?
Can you repeat that?
But yeah, there's participating and non-participating. So what it is, if it's participating, what that means is it goes preferred, the dividend goes to preferred, then it goes to common up to a certain point. I'll put this over here. And so if it's participating, it goes preferred, then it goes to common, then when it reaches a certain cap, it goes back to preferred. So they get their due, the preferred get their due. In this case, remember the 30,000. Then I'm presenting numbers here for illustration. Common stock would then get, I'm presenting number 20,000. Everything above that goes back to preferred.
All of it.
All of it. Well, I'm just saying all of it because it's easiest to see. It can be a kind of a complicated formula, but let's just say all of it because it's easiest to see. But what it means is the preferred do get their due before, and instead of all of the remaining going to the common, which is what we've had up until now, only part goes to the common, then once that cap is reached, it goes back to the preferred. And that's participating. And it's kind of an unusual thing, but let's throw out the definition now. And then all you got to do is, in this case, you just got to know the definition because you'll never have to work out the math. Okay? How you guys doing? Antonio woke up. Jonathan woke up. Nate looks pretty blurry-eyed. You know, one good thing about accounting is it's very relaxing. Listen, you guys, let me share. No, seriously, look, one time, this was several years ago. In that case, the publisher gave me these tapes, right? So this lady was going on a business trip, and she said, I'm really worried about getting behind. I says, I've got just the thing for you. I have the lecture tapes. Let me lend them to you, right? So anyway, I lent them to her, and she came back from her business trip, and she returned the tape to me and says, I hope it's okay with you. I copied these. And she said, I've had insomnia all my life. Nothing has ever worked. As I popped these in the tape, not like a light. And she says, I sure think, and I thought, you know, we try to do good. Sometimes we just don't know in what way. Like Jonathan, he may have been kind of stressed out coming in here, right? And it's just, yeah, Antonio, yeah, unfortunately Jonathan snored. By the way, guys, I'm kidding. Do you know what I think happened in this is, we never got into it, but this whole thing was invented by a guy named Father Luca Pacioli, right? And you know how there's a yin and a yang? Well, this, you know, debits and credits, it really ties into the same system. And so I think it just really resonated with this deep inner core that all of us have. Just like yin and yang and qi and chi and all that. And I think that's why she felt, you know, kind of like she, yeah. That's what happened. Anyway, you guys, let me put up the answers and let's get on to the next one. So this is 13.5. All right, how's this for a set of answers? Does that look like what you guys got? See if there's any questions. we'll get on to treasury stock. All right, I'll start pulling this together if you guys are okay with that. And let's get into treasury stock. Okay. All right. Okay. You guys, what I'm feeling is that you guys are really getting a lot out of this class and everything, right? Is that, am I reading that right?
Mm-hmm. Yeah.
And it would be tough to do without the class. I don't know.
Yeah.
Let's do this. Let's make this. Let's. You know, at the end of class, I would like to go spend a little bit more time with chapters 13 and 14. I hope I'm not telling you guys to take a vacation here, because that's not what I mean. But I'd like to work through it. Let me rearrange our schedule, because at the end of the quarter we have this project, right? Well, we have a couple days where we're going to present the project in class. Let me change that to just a hand-in project, rather than actual presentations. And let's spend a day or two extra in chapters 13 and 14. And the thing is, 13 and 14 are kind of the core, because it's one is stocks and the other is bonds. And so let me rearrange the schedule. Let's spend a couple extra days with 13 and 14. We'll not do our presentation in class, and I think that's how we'll get the most out of this course.
Yeah.
Then when you guys go to your four-year school, I think you'll have a better foundation to build on.
Will you still have the homework that we're going to do tomorrow?
No, let's change that, and then you guys, I want to get back to work. And I think that's just, and all I'm trying to do is make the best of the course. And I think, and it just seems to be going well. As though, and I'm just, how can we spend our time the best is what I'm thinking. And so let's go ahead and do that. So as far, let's just settle this homework till I have a chance to sit down with the schedule and modify it. And then I would like to, and I think that's just how we can spend the best. And when you guys go to your four-year school, then, now today is Tuesday. Let's have the homework due like Friday.
Chapters will be.
Yeah. And then I'll do, what I'll do, because there's just so much to this. So right now it's due on tomorrow. Let's have it due, I'll start, yeah, let's do this. Let's have it just here. And then I'll modify the schedule after that. So it'll be due Sunday night. And that'll give us another day on this. And I think you guys, because all I want you to do is shine when you go to your four-year school. No, seriously. And I think this will enable you to shine.
Was that change the homework quiz tonight too?
Yeah, I'll just move everything to that. And again,
I mean the chapter quiz, sorry.
Yeah, the whole thing.
Okay.
Chapter 13 will be due the 27th. And all I mean to say is I think that's how we can make the best use of our time. And now, then everything else will move forward, but let me sit down and just plow it down a little better. And it just see, and all I mean to say is I think this class kind of resonated, like I think we can make good use of our time. But now, I'm not telling everybody to take a vacation, right? It's not escape time.
No.
It's just because I want you to shine. Yeah,
No, this is awesome. The main issue that I'm having with this chapter, and I don't know if anyone else is, but it's just inverting certain things that you need to do at one time, okay, and just mixing up, certain things. So it's just a matter of keeping everything straight.
Mm-hmm.
And so many of the definitions are similar to a certain degree, making sure that, because there's 56 just in this one chapter. And so trying to keep those straight and seeing when to apply them and when not to, and not mix them up. If we can focus on somehow trying to come up with the right steps on how to do things.
You know, if I understand you correctly, the way I think this has to work is it's just practice. And if you do the homework and the exercises, that's the way you sort these things out. And it's just, I don't think there's any other way of doing it, because it's something you got to do.
Right.
It's not something you can really read or study or explain, you do. All right, well, I think that should be good. Let's go ahead and do this. All right, so you guys, I feel a lot relieved because I got some breathing room now, and we can make good use of our time. Okay? All right, so let's get into treasury stock. That was the next thing we were going to do. Now, I think I'll turn this around and just go to the other board. Okay.
Wednesday and chapter 15.
Is that?
So we can spend Wednesday and chapter 15.
Yeah, and we'll wind up, and we'll start chapter 14 on Wednesday. And we'll make it then, and it'll turn well. Okay.
Seems like the longest chapter so far, 13.
And 14, yeah, 13 and 14, and by the way, they're doable, they just require a little more time is all, but they're doable, okay? Okay. Now let's get into the idea of treasury stock. Now with treasury stock, what we're talking about here is a company buys back its own stock. So a corporation buys back its own stock. Okay, is what happens on this thing. And again, the thing that's realized here is not an asset. Okay? Rather, it's a contra owner's equity. Okay? So it's not an asset, it's a contra owner's equity. Okay? And so this is kind of one secret to understanding how the chapter works. And somehow you think they own something, it should be an asset, and all they do is, it's a contra owner's equity. And that's one secret to making this whole thing work. Now sometimes what they do is they, and the other thing to make it work is that, and everything is at cost. Okay, so if you understand it's at cost, that it's a contra owner's equity, okay, and a company's buying back its own stock. So the reason they do that is because maybe they have too much stock out on the market, and they're concerned about somebody gaining 51% by buying all these loose shares. So they bring in extra shares. They have shares they can pass on to their employees as a reward. When they do that, the employees then become owners of the company, and they start thinking long term, right? So for instance, Tektronix had this reward program. What they did, it's along these lines. It's not a treasury stock per se. It's not a stock option. But what they would do is they had a profit sharing plan, and what they would do is at the end of the year they would take their profit and they would give a healthy chunk of that profit to their employees. Now their employees started acting like owners instead of employees. Instead of grousing, trying to form a union and all the rest of that, what they would do is, so for instance, they would walk out to their car. They see a nail in the parking lot, they'd steep down, pick it up, and put it in their pocket. So the delivery truck didn't get a puncture, right? Because they cared. Now at some point in time, it quit working because they grew and grew and grew. When they were small, everybody felt significant. But when they got large, it didn't matter anymore because you were just one of, and so it quit working. But they grew. At one time, they were the largest employer in Oregon. I don't know where they are now, but okay. All right, and you can also use it to support market price. So let's start out with an example. So in this case, what they do is they purchase 2,000 shares of their own stock, okay, for $4 a share, okay? All right, so 2,000 times 4 equals 8,000. So on May 8th is when they made the purchase. They have treasury stock, common, because they're buying back common stock. It would be treasury stock, common preferred if it was preferred stock. They're just buying back common stock. That's a debit of 8,000, and cash is credited for 8,000. Okay? And so what they're doing here is this treasury stock common, it's a contra owner's equity account, and it lessens the owner's equity. And of course cash lessens correspondingly. Okay? And don't forget, this is at cost. This is what they paid for the treasury stock, and it's a contra owner's equity account. And it's not an asset. Okay? All right, now what they do is they sell 100 shares of this treasury stock for $4 each. So when they do that, 4 times 100 is 400. So now on June 30th is when they made the sale. They debit cash for the 400, and they credit treasury stock comma, common for the 400, okay? So this treasury stock, comma, common is that treasury stock, comma, common, okay? Okay, this account is that account, okay? Now, on the 19th, they sold 500 shares for $8 a share, okay? So, now, I'll take this arrow out here because it's kind of in our way. Now what they do is they sell 500 shares for $8 each. Now, they paid, when they bought them originally, they paid $4, right? So now they're selling them at a gain. So when you do that, what we got here, so July 19th is when they actually make the sale in this one. So in other words, 8 times 500 is 4,000. So on July 19th, cash is debited for 4,000. And treasury stock, and where I'm getting this is 8 times 500 is the 4,000. Okay? Now, they paid 4, right? So 4 times 500 equals 2,000. And so now, treasury stock, comma, common, is credited for 2,000. And so what happens here now, it's a contra owner's equity account which has a normal debit balance, right? You're lessening it by 2, so you credit it, right?
Correct.
And then the difference is paid in capital comma treasury stock.
Is it paid in capital in excess of par?
No, good question, but not in this case. All you're saying is, when you sell your treasury stock for more than you paid for it, that excess goes into this account, paid in capital treasury. And it's an owner's equity account with a credit balance, so it increases the value of your owner's equity. So this will decrease the decrease, and this will increase it. Okay, yes?
So paid in capital, treasury stock is a different account completely than the paid in cash or paid in par,
Exactly.
paid in capital account.
And the reason it's a different one is the one that says paid in excess of par, okay, that is contributed capital,
Okay.
right? And that's contributed capital. This is an owner's equity account reflecting selling treasury stock at a gain.
The equity is
Sure, this will increase owner's equity,
okay.
and this will also increase owner's equity because it will decrease the contra account,
Okay.
okay? And these are good, great questions.
And then there's, I'm sorry.
Sure.
How come on none of these par isn't on there though? Like how come you don't record par?
It's a good question, because again, it's at cost. It's at the cost of the treasury stock. So the par is not relevant at this point. Now, just as a heads up, the only time par will come in is when you retire the stock. And that'll come up in a later step, because when you retire stock, you remove, when you retire any asset, you remove all accounts from the books. But until that final, don't worry. And again, everything's at cost with the treasury stock. Is way you understand. So everything's at cost. Yeah.
And that's indicative of any time you have a T-stock that you're going to be selling, it's always going to be at cost. That's the general
Exactly.
rule. There's no ambiguity.
Yeah, and, not in this class. At this class, treasury stock is always at cost.
Okay.
Now, when we retire stock, that will be a different matter. But the treasury stock, will always be in this, and retiring does involve more. But that's a different matter, okay? Yeah, because when you retire the treasury stock, then we'll show you that step, and that will be a different step.
Then you have to segment out what's going to be going
And again, all you're doing when you retire the treasury stock, and I hope, maybe I should, let's just hold off till we get there, maybe that's it. When you retire, when you remove any asset from the books, you take all, when any assets retire, whether you discard it, or in this case, you're retiring the stock, all the related accounts are removed from the books. Okay, that happens whenever you remove any asset. Okay? All right, why don't you guys do quick study 1311, and you find that on page 537. Okay? And I'll go ahead and put it on the board here. So it's exercise 1311, page 537. What it asks you to do, it asks you to go through these steps. Okay. So it's exercise 1311. Here it is. So exercise 1311. And I'll go ahead and I'll turn that camera around in a minute. So here it is. Oh, I'm sorry, this is exercise 1311. No, quick study 1311. That's what's not making sense. Here it is. Here's quick study 1311. All right, so on May 3rd, Lessman Corporation purchased 3,000 shares of its own stock for $27,000. All right, on May 4th, I'll turn this camera around, so then on May 4th, Lessman issued 750 shares of treasury stock for $708. Now don't forget, you got to divide the 3,000 and 27,000 to get the per share cost. Divide this into that to get the per share cost, and then you can see whether it was sold at a gain or a loss. Okay? So don't forget, you need to divide 3,000 into this to get the amount per share, 750 this to get that a share, and there'll be a gain or to see if there's a gain or a loss. All right, so here's where they make the purchase. So treasury stock is debited for $27,000, cash is credit for $27,000. So now, of course, the asset goes down and they have a contra owner's equity account, and it's $9 per share is the cost. Okay? Now, when they sell it, so now it was $9 per share was the cost, and when they sell it, it's 750 treasury shares at $9. So here's the cash they received, right? Here's the treasury stock, so 750 shares at $9 each is that. Then the difference goes into contributed capital treasury stock. And contributed capital treasury stock is the same account as paid in capital treasury stock. And again, two different people, one wrote the textbook and the other wrote the questions. Same account. In this case, you're treating it as a plug figure. So are there any questions on that before we move on to the next step? All right, let's do this. Now, so let me get this whole thing on the board. Okay, now let's do this. Now, are there any questions on that? You guys, yeah, Michael.
So in this, on the November 4th,
Okay.
what happens if that had been, so if it's been a loss,
Mhm.
then instead of contributed capital treasury stock, what would the name of that?
What would it come from?
Yes, it would come from retained earnings. And the answer to that would be retained earnings. We kind of anticipate what we're going to do next. It would. So what happens on this thing is the retained earnings is always going to be the little reconciler.
Okay.
So in this case, so what you're saying is suppose they would have sold it for $5,000 instead of, which would be less than $6,750. So what's happened is they sold it for an amount smaller than this, $6,750. Like suppose they sold it for $5,000. Well, then of course cash would be debited with $5,000, and then in this case retained earnings would be debited for $1,750. Yeah, but you kind of anticipated what I was going to say next, but that's fine. Does that make sense?
Yes.
All right, so let's go ahead and by the way, that's really good because retained earnings will always will be the fallback. Okay, so now what they do is in this case, so now on October 27th, what they do is they sell an additional. Okay, so they sell 400 shares for $1.50 each. Okay? So what you do on this thing is 400 times $1.50 is 600. So the deal is on August 27th is when they made the sale. Cash will be debited for $600. And it's $1.50 times 400 shares. Okay? Now, what happens on this thing is, let's go down to the credit entry, common stock. And common stock will be 400 times, with $4 times 400 would be $1,600. So they paid $4 for it, they sold 400. That means treasury stock will be debited. Okay, that means that treasury stock, common, will be debited for $1,600.
Wait, is it debit or credit?
Hmm?
Is it debit or credit?
It'll be a credit, because what it is this account here, right? It's the contra owner's equity account.
Yeah.
And then you have a plug figure of $1,000, and that will come out of paid in capital, treasury. So, in this case, and this is kind of feeding off what we were talking about with just a little earlier, in this case they did sell it at a loss. So the first thing you do is you take it out of paid in common treasury, paid in capital treasury, and so there's $1,000 left. If this were exhausted, then you'd exhaust it and take the remaining out of retained earnings. Okay? If it didn't exist, it would all come out of retained earnings. Okay? Yeah.
So in this example,
Yeah.
1,600 was a given, right?
Well, don't forget, a treasury stock is at cost, right? And so you're selling treasury stock and you record it at cost. So you paid $4 when you bought it. You bought it for $4. And if everything's at cost, which is the secret to making this work. So then when you sell 400 shares, treasury stock is credited for 4 times 400, which is 1,600. So you got 600 in cash. Treasury stock is credited for 1,600 because it's always in cash. You have a $1,000 plug figure in effect, and that plug figure comes out of paid-in capital treasury. So this account is that account. If you had exhausted this account, then the rest would come out of retained earnings.
So you would debit paid-in capital and retained earnings?
Yes, exactly. So exactly. So suppose this had been a figure like 2,500, right? Then 2,000 would be a debit to the paid-in capital common treasury, and the remaining would come out of retained earnings. It's a good question. All right, you guys are okay with that? Let's do this. Why don't you do exercise 13? Let's do this exercise 1310. Why don't you guys do part 1, and then I'll do part 2. So do part 1, and I'll do part 2. So it's exercise 1310. That would be the one just previous to this. Well, exercise 13. Yeah, okay. So on October 10th, stockholders' equity of note system appears as follows. So you have common stock, $10 par, 36,000 shares authorized and issued and outstanding for $360,000. Paid-in capital excessive par, common stock 108, retained earnings 432, stockholders' equity 900. Prepare the journal to develop the following transactions. So you purchase 4,500 of its own stock for $30 per share on October 11th. Then you sell 1,200 shares for 36, so you sell it again. Then you sell the remaining at a loss. Okay, and then I'll do step 2. And what we're doing is we're reviewing everything we just went over, if you want to kind of I'll go ahead and put the camera here. Okay, let me kind of give you some feedback here. So here is where you purchase the treasury stock. Okay? So 4,500 shares, $30 each. Treasury stock, account for owner's equity account is debited for 135,000 cash is credited. Okay? Then you sell at a gain. So you bought it at 30, you sold it at 36, so cash is debited for 36 times 1,200, the number of shares you sold. Treasury stock is credited for 30 times 1,200. The difference goes into contributed capital treasury stock, which is the same name as paid in capital treasury stock. Same account, different name. Okay? And then you sell at a loss. And so it'll come out of contributed capital. If this is exhausted, the additional will come out of retained earnings. I'm not sure what it is. Okay, and here's the last one. Okay, we're doing good on that. So now I'm going to put this over here so we can kind of see everything at the same time. Okay. And here's what the owner's equity section looks like after we, so what it is after this first purchase right here, after this first purchase, that's what it looks like, okay? So I'm just going to get something to cover that with. So it's at this point in time. So the way it will look is like this. So common stock, so let's compare the two. $10 par, 36,000 shares authorized issued. Now you report 45,000 shares in treasury. The 360,000 remains unchanged. Okay? Then you have retained earnings. That stays the same. The total contributed capital, of course, remains the same. Now, retained earnings, 135,000, here's where that number's coming from, restricted by treasury stock, 432,000. So what it boils down to is, here the number change unchanged, but it shows that some of that is for treasury stock. And below that, less the cost of the treasury stock of 135, and now your stockholders' equity has decreased by 135. So here's how it's reported, okay? So the number of shares, the common stock is unchanged, but it reports the treasury shares here. It reports that the value of the treasury shares will restrict the retained earnings, but it doesn't change the number. Then it reports the treasury stock down here and lessens the equity by the treasury stock. So that's what it looks like on the statement of, down in the stockholders section. This is a balance sheet. It's the stockholders equity section, which is the owner's equity section of the balance sheet. That's what it looks like.
So why does it say that there are 4,500 shares in treasury when we resold those shares?
Oh, it's after it's as of October 11th.
Oh, okay, gotcha.
Yeah, and so it's after this first transaction. The other ones, the other two have not occurred, as far as they've not occurred yet. Okay? All right, any other, yeah?
So why are the 4,500 shares in the treasury, that calculated amount, the 135,000, a separate line item for the accounting purpose? Because I mean, you've got common stock, $10 par value, 36,000 shares authorized, and then issued 4,500 shares in T-bills, or T-stock.
And again, all I gotta say is the conventions that they follow. Yeah, and it seems like, and what you're kind of thinking is this should be reported at, and again, the way it works is the treasury, it actually is it's its own account. So the way it works is its own account, it's a contra owner's equity account, and it is subtracted from the owner equity down here at the bottom. However, its effect is recorded here and it's recorded there, although it doesn't change the amounts. But it does say there's a, down here, this is where it's accounted for. But it's reported here and here. Okay. All right, sounds good. All right. So you guys doing good. Let's have a quick summary. Let's see, what do we got? We got 10 minutes left? No, we got 15 minutes left. All right. Let's have a summary. And then, I think this will tie everything together nicely. Let me turn this over here. Put this here. And let's just summarize everything. Summarize the treasury shares. So let's have an example here. So in this case, what we have is so you're authorized, this corporation is authorized 1,000 shares, and it's $10 par. Okay? And all I'm going to do is just show you how everything fits together by walking through an example from beginning to end. Okay? And we'll start out when they initially sell the stock, and we'll take it one step beyond what we did here when they retire the stock. And we'll just show you how everything fits together. Okay? So the first thing they do is they issue 100 shares at $15 each. So when that happens, cash will be debited for $1,500. And this, I'm going to move that over a bit, and I think I can kind of keep it all in one. Okay. Common stock will be credited for 1,000. And where I'm getting the first one is that 100 times $15 is the cash, 100 times 10 is the common stock, that'll be legal capital. And then 1,500 minus 1,000 is 500, and that'll be paid in capital in excess of par. Okay. Now, they purchase, so the second thing is they purchase 10 shares at, and this is treasury stock, right? At $25 each, okay? So that means the treasury stock will be debited so 10 times 25 is $250, and cash will be credited for $250. So here they made the initial issuance of stock, sale. Here they bought back 10 shares and they paid $25 each, okay? Now, they're going to sell some of their treasury stock, so they sell 3 shares of, I'm going to put T/S. Is everybody okay for treasury stock? Okay, at $40 each. Okay, so cash will be debited. So 3 times 40 is 120. That's the cash they bring in. And treasury stock, in this case, it was $25 each, so 3 times 25 is 75. A plug figure of 45 will be paid in excess of treasury stock. Okay, does that make sense? Everybody okay with that? All right. Now, in 4, what they're doing, I'm going to make sure this camera is lined up here. Make sure I didn't. Yep, that'll work just fine. Okay. So now in number 4, they
Steve?
sell. Yep.
What's that word after 40?
On the,
We'll get each.
Each, okay.
And thank you, and I'll slow down. Okay. Now they sell 2 shares of treasury stock for $5 each. And we're at T/H at $5 each. Okay? So, cash would be debited for 10. Paid, okay, and treasury stock will be credited for 50. We have a plug figure of 40, and that comes out of paid in excess of treasury stock. That makes sense? So this paid in, is that paid in? Is everybody okay with that so far? Adding up, okay. All right, and it's below cost, okay. Now, we're going to do a number 5. So now they're going to retire. So they retire 5 shares of treasury stock. So we started out before the treasury stock, and we're going to take it one step further than we did in class. And when you retire any asset, you remove all of the related accounts from the book. So in this case, common stock will be debited for, let's see, it's 5 shares, and common stock is $10 par. It'll be debited for 5 times 10. So it'll be, so to remove this related account from the book, we're going to debit this owner's equity account for 50. Paid in capital in excess of par. Now in this case, they sold it for 15, so that's 5 above par. 5 times 5 is $25. So we're going to remove that from the books. Paid in capital in excess of treasury stock.